Good morning, afternoon, and evening to all of our viewers across the globe. From WHU Inside Business, I am your host, Nicholas Peterson, and I'd like to welcome you to our all-new virtual studio here at WHU Inside Business, where we are tonight debuting the first live episode of our all-new program that we call Perspectives. Since 2018, we have been producing insightful one-on-one interviews with many of the business leaders connected to our WHU network. But tonight, we have decided to change it up a bit and bring you an entire panel for a fair and live discussion on the monumental shifts that have occurred in the global financial markets since the year began. I will bring you back to the start of 2021. In January, the infamous short squeeze of GameStop, triggered by users of the subreddit Wall Street Bets, caused short sellers to lose around $6 billion globally. In February, Tesla bought $1.5 billion in Bitcoin, and subsequently Goldman Sachs restarted its cryptocurrency trading desk. In March, a non-fungible token, NFT, in the form of a JPEG file sold for $69.3 million at Christie's, and Jack Dorsey's original tweet sold for $2.9 million. In April, Ethereum touched a new peak with reports about the European Investment Bank's plan to launch a digital bond sale on the Ethereum network. Finally, Dogecoin, which started as a joke designed to illustrate the absurdity of the cryptocurrency friendly, is, brace yourselves, up over 11,000% this year to date. Now, with all the craze that we've witnessed so far, we at WHU Inside Business decided to partner with Impraxi, the Alumni Association of WHU, and assemble a panel of expert alumni to discuss the impacts of these phenomena. Now, before I introduce our guest speakers, I'd like to quickly go over how this live stream will work. So we will be sifting through comments live from all of our platforms. That includes YouTube, Facebook, Twitter, and Twitch. And my team and I will assemble and take some comments and post them on the screen during the discussion if they are relevant to what is being discussed. If you have a question directed to a particular speaker, please preface that in your comment as such. And without further ado, I'm honored to present our panel for this evening. First, we have Matthew Eckroth. Matthew Eckroth is a former systematic portfolio manager and strategist with nearly 20 years of experience at investment banks and hedge funds, including Goldman Sachs, Lehman Brothers, and Engineers Gate. Over the past 4 years, he has headed data strategy efforts at Sentient Investment Management and Morgan Stanley & Co. International. Matthew attended a post-degree course at the University of Mannheim and began his career as a financial analyst in Frankfurt. He is a fintech enthusiast and has recently launched a company to offer comprehensive data strategy as a service to investment management firms of all sizes. Welcome, Matthew. Second, we will be joined by Dr. Boris Vetz. Boris, who completed a master's and PhD at WHU, class of 96 and 99 respectively, is a founding partner of Version 1 and one of the top tech early stage investors in North America. Born in Germany and based in Vancouver, Boris takes a wide-angle view to find great companies all across North America, from New York and Toronto to Seattle and Los Angeles. He is a board partner with Andreessen Horowitz and is well respected for his uncanny ability to find the next generation of leaders. Today, Boris is focused on crypto and blockchain, marketplaces and SaaS, looking for the best teams who solve big problems in a unique way. As an investor and former entrepreneur, Boris knows when to push and when to ease off, while always remembering that he is an advisor and not a player. Third, first of all, hi, Dr. Vetz. Welcome.
Thanks for having me.
Thank you. Third, we're joined by Dr. Jürgen Wurf, who completed a PhD at WHU, class of 2003, is an innovator and entrepreneur of payment solutions, digital currency, and financial technology. He was the founder and CEO of Mercedes Pay, formerly called Paycash, and led the company, a patent-pending fintech company offering e-wallet and payment services in the EU, China, the US, and Canada, from inception to acquisition by, of course, Daimler. Mercedes Pay was the first regulated institution to legally cooperate with U.S. Bitcoin exchanges in Luxembourg. And finally, our first panelist this evening. Hi, Jürgen. Sorry. And our fourth panelist this evening is Simon Peters, who completed his bachelor's at WHU and is the managing director of Decus Network GmbH, an all-in entrepreneur with a passion for challenging markets and disruptive technology. Previously, Simon worked as venture pioneer at the impact-driven company builder Ampion Ventures. His vision is to build flexible, incentive-based networks, replacing rigid systems. And first of all, hi, Simon. Welcome.
Thank you.
And last but not least, our moderator for this evening is our very own Dean of Students here at WHU, Professor Dr. Markus Rudolph. And with that, ladies and gentlemen, I hope you will enjoy the following discussion. Please post your comments and be sure to like us on LinkedIn, Instagram, everywhere you can find us. And without further ado, Professor Rudolph, the floor is yours.
Thank you very much, Nicholas, and good evening to everybody. First of all, to the speakers, I'm very happy to be able to moderate the discussion which is coming up, and I'm very happy to see some of the faces, at least, that I have seen already here in the classroom, and this time as successful entrepreneurs in front of me. And I may say that we are all a little bit proud on what you have achieved and what the WHU alumni are achieving, and that is also because that's also why I'm so happy to be able to be the moderator of that WHU Inside Business session tonight. Because I heard that we have a 3-digit number of participants taking place tonight. I don't see it here on the screen, but we obviously have many people who are following us, and that's great. I would like to say hello to everybody out there, either people who have been members of the WHU community or people who are not yet members of the WHU community, but we are very happy to discuss with you important topics. Well, the topic today is old school finance debt, and it's maybe a little bit characterizing that Nicholas asked me to moderate such a discussion on old finance and how old finance can be shifted into new finance, because I am a professor of finance here at the school since many, many years. Jürgen knows that. We have a common time, which is almost 20 years ago, meanwhile. And what we learned in the classroom when we're talking about old finance is very much about efficient markets. So the efficient market hypothesis is one of the core elements of what we would call classical finance or old finance, however you would like to call it. And by the way, the efficient market hypothesis driven forward, especially by Gene Farmer, but by many other economists as well, has been rewarded by the Nobel Prize comparatively recently, together with some behavioral economists like Robert Shiller. So in other words, this old finance, at least in the classroom and in the research area, seems to be still relevant. Concepts which are rewarded by Nobel Prizes are by definition relevant. And now the question is, what is it what we are faced with in these days? And I would like to start with a phenomenon that Nicholas has already teased on a little bit, namely the development of the GameStop Corporation share price, which we have been able to observe in January this year. So in other words, comparatively recently. I mean, what we have to know is that GameStop is a comparatively, or has been a comparatively boring company in the sense that they were basically selling video games. They did have a record revenue. It's a big platform, big company selling video games with 56.9 billion of revenue. So in other words, it is a classical company, however, a company which has been founded in the years before the internet hype was started. And now, of course, gaming is as popular as it never has been, but you don't go into a store anymore and buy the games over there. And that is the reason why in January 2021, a couple of investors, especially institutional investors, hedge funds, were trying to make profits by going short into GameStop shares. And I think the hedge fund which was probably most involved here was Melvin Capital, a New York-based company with 6 billion assets under management. And then something happened, what probably did never happen before, namely something crazy, so to say, happened, at least from the viewpoint of the classical old finance, namely users on a Reddit forum called the Wall Street Bets. They basically put themselves together to a crowd and were betting against the 6 billion hedge fund, which was shorting GameStop shares, with the effect that the GameStop share price within only a couple of days or weeks has been multiplied by the factor 16. And of course, if you know, I mean, if you are short on an asset, which then multiplies its value by 16, then you have a problem. And de facto, you had a problem. And the first question that I would like to raise is that what we are observing there only crazy, or is it really a contradiction of the efficient market hypothesis? So is it still so that all relevant information is reflected by market prices, or is this something completely new? And if I may, I would like to start passing this question to the only one here who at least was for a while a classical banker, namely Matthew. If I may, can I ask you for your understanding of the situation and give us a little bit more orientation here?
First of all, thanks very much for the invitation to attend the panel tonight. Very excited to be here. Yeah, there's a lot of interesting things happening in the financial world in 2021. GameStop certainly kicked off the year with a bang. And as Professor Rudolph was just mentioning, the laws of traditional finance and market security pricing seem to be not applying anymore. And the question is, what is really going on here? And I think there's some unique issues going on that are equally relevant for GameStop and Bitcoin. We'll come to that later tonight. But with GameStop, as you pointed out, this started out as GameStop is a company that many people in the U.S. will be familiar with. They're an old school bricks and mortar store that is in most malls in the United States, and was until recently really a dying company. Their business model was just really old-fashioned, old school, and smart operators. I use that in parentheses. Smart operators like Melvin Capital saw that this was a dying company and basically betting on the stock going to zero. Market practitioners are well aware of the short squeeze phenomenon, where if too many market participants take a short position, they're potentially vulnerable to a short squeeze. And that usually means the stock might go up 10, 15, 20%. Maybe it would go up 100%. But something very unique happened with GameStop that never really happened before in the public markets. And that is, you had a literal retail army primarily through the Wall Street Reddit's blog, over a period of months, decided to more or less to band together. And GameStop became much more than just a stock play or an investment for retail investors. It became to represent a movement, and that movement took on a life of its own, and it became a self-feeding process. The more the stock went up, the more that the early investors made money, and the more of these people were posting their Robinhood balances on Wall Street Reddits, exciting even more people. And then it just kept going on and on until the stock went up to, I think, almost $500. So something very, very special happens here. And it is very, very different from what certainly people like myself who've been in the markets for many years are used to. And I can tell you that it scared to death a lot of people in, let's call it, in old school finance and traditional brokerages, because it seemed to upend the rules that the market has been playing by. And the question is whether these rules are still applying now.
Thank you very much, Matthew. Boris, you are at least somebody who is investing into a company, who is used to investing into companies. Not sure whether you are a publicly listed company investor, but you're investing into companies. So in other words, this is a phenomenon which should interest you as well, because there might be conclusions drawable also to the kind of investments that you are doing. So what is your judgment of the situation? How would you evaluate it?
Yeah, I think it's super interesting. I mean, first of all, version 1 is only investing in private companies and hope that these private companies go public at some stage. But I think what is really interesting to see what has happened over the last little while, independent of public stock investing, is just the power of narratives, the power of social media, the power of communities, the power of memes, and all of that is like a bigger trend that I think is influencing kind of how companies are valued in the eyes of other people, right? And you obviously have seen that play masterfully by Elon Musk with Tesla, where everybody would agree that Tesla not necessarily gets valued anymore on pure economic outlook, but also by the power of the narrative of an Elon Musk and how he's communicating that. And I think what we've seen for the first time now in GameStop is just that the power of the narrative, the power of the meme, the power of social media was not done by a single person, but by a community that organized themselves, right? And so I think we're going to see more of that going forward in a world that gets more and more complex and noisy. Sometimes simple narratives, simple memes have a really powerful impact on people, and we've seen that playing out with GameStop, and we see that playing out every single day in crypto, right? And we'll talk about that later. But I feel like that's probably the market in general. It's not a single coin that is driven by that, but it's the whole market that is driven by that. And so I think it's something that we're gonna live with for better or worse going forward.
Right. Thank you, Boris. I mean, if you say memes, memes is basically another word for a certain way of information processing that you have in the internet. And forgive me that I tried to get back to the original question. The original question is information still reflected by market prices? So when you are saying these are memes, this is another kind of information than the one that they typically have. I mean, when I was young and when I was learning finance, you read the newspaper and maybe had a Bloomberg screen, but you didn't have that speed of information. You didn't have memes and narratives and these things. Maybe Simon or Jürgen, would you think that we need a new market efficiency theory if memes are the dominant pieces of information rather than old-fashioned information?
Well, let me start with it. I mean, I fully agree what Boris and Matthew said, but I think there's another thing on top. I think the time when it happened, I think the market changed because there was one effect, which were all the checks that were distributed in last year because of the COVID to a vast population in the US. And the second thing was the Robin Hoods, N26, Trade Republics of the planet. So trading with small money became more, it was a lot of gamification there. That was 20 years ago when you were sitting in front of a Bloomberg screen or filling out a form in Deutsche Bank to buy a share was totally different. So everything was at your fingertip. There was not the classical media break anymore. So you get a Twitter message and a second later you could trade whatever you saw there. No matter if the information was that somebody was invading the Capitol in the States, or somebody was posting that it just made a lot of money on the share XYZ. So I think there's this component that, what Markus, the German government is trying since I don't know how many decades to kind of like to put more people on the stock market. That was happening especially in the States, because of the checks that were distributed by the government and people didn't know what to do with it. So they said, let's play around with it. And they had the technological ability to really exercise all of that. And that became so big, much bigger than the classical people with an education would imagine that it would happen. And I think this is something new. I still believe that these people at some point of time have to buy finally the washing machine that they were supposed to buy with this $1,500 US that they got the check for. And then they may act a little bit more rational than they were doing when they thought they were just gaming on something.
Thank you. I also would like to ask Simon for your opinion, and the other gentleman, please just raise your hand analogously. I can see it. I don't know where there is a digital hand if you want to talk. But Simon, have you got an opinion on it?
Absolutely, and I want to build on all the things that the speakers before me said, and especially on a wording that Matthew used, the retail army. And we're seeing these armies organizing themselves, right? We saw that on Wall Street Bets with GameStop. We see that on all the crypto forums, right? Like there's a million Wall Street Bets on Reddit for crypto alone, and these meme boards, these online boards that organize themselves, right? We've seen that somewhere else too, QAnon. And what is QAnon again? It is this online board in anonymity where truth drops come. And when we look at Wall Street Bets, in a sense, it's again a truth drop. Like somebody drops something that may or may not happen, and you'll feel free to believe it. But the idea that I, as an anonymous person that maybe has not been part of any special group, now can join online without any limitation and become part of this kind of group that shares secrets, secrets that nobody else has, that just we as a selected one have, and can, in case of Wall Street Bet, can even make money on it. I think that is something that has a very powerful psychology behind it. And I think this is something that we have to understand, that these are the new way or new form of social organizations. And we see them politically, we see them economically, and we also see them socially. And it's all driven by an incredible speed of information, right? What was mentioned, I now can see the tweet 5 minutes after it was tweeted, can directly, switch my app, go on Robinhood, and put $500 into it. And I think this is really what we have to understand, that there's a new kind of social organization coming around. Yeah, I think that is, yeah.
And Simon, is that speed of information contributing to more market efficiency or to less market efficiency? I think this is the
I would say really the market. I still believe that the markets are in of itself efficient. Now the question is, what is this value at what we're seeing? Is there any real value in that? Could it be that the GameStop investor had a point? Like, is there a real point that there maybe is a brick and mortar retail store that it's definitely going out of business? All our, like, if you look at it in analytic cases, if you make an analysis, it becomes clear GameStop should go out of business. But maybe the community around GameStop is something that wasn't really qualified. And wasn't really understood as a market mechanism, but now these fans of GameStop, pushed up the course at least partially, maybe they've made a statement. So I would say maybe I think market is still efficient. We just need a new way to read into that.
Yeah, I'd like to add here to Professor Rudolph's question is, should we throw away Fama and French and efficient market hypotheses because of what happened with GameStop? I think the answer is definitively not. I love Warren Buffett's saying that in the short run, markets are a voting machine. In the long run, they're a weighing machine. So, and the market is voting. And the market, when I say the market here, I mean heavily Wall Street Reddit retail-based market has decided in the near term that GameStop is worth a lot more than the professionals think it's worth. At the end of the day, why does anybody buy an equity? You are buying a share in a company, a stake in a company, because you're valuing future cash flows that you'll receive as an owner of that company. Well, GameStop is not returning any cash flows to investors right now. So either the retail trading population has a much better prediction ability than the institutional investors, and they're seeing the company transform in a way that hasn't been seen by institutional investors. So again, I think the answer is we need to wait and find out what's going on. My view is that there's something very different going on that is very unique to GameStop. I don't think in this movement there can be another GameStop. AMC might be kind of a mini GameStop phenomenon, but the other names that have been mentioned on Wall Street Bets that come up in the kind of the retail chat rooms, if you look at their price action, many of them have gone up as the chatter has increased, and then when the chatter moves on to another name, they go right back down again. And GameStop had this as well, but the stock actually has been surprisingly stable for a while now, for I think 6-7 weeks, around the $150 price, which is still very, very expensive relative to a comparable company in the same situation. But I think GameStop is the exception that confirms the rule.
All right. And I mean, we were talking about cryptocurrencies quite a couple of times already. I mean, when we talk about, of course, Bitcoin, that Nicholas, you have mentioned that basically was pushed only because Elon Musk was sending a tweet, or Dogecoin, or what we are currently observing in either in Ethereum, even though I personally think that Ethereum and Bitcoin is a completely different thing. However, if we go from GameStop to cryptocurrencies, is that a comparable phenomenon? Namely, the fact that based on social media, immense market movements are taking place, or is that a completely different thing? And of course, I'm always having the efficient market hypothesis a little bit in my back mind, but how would you judge that? Is the Bitcoin case, Boris, maybe, I think you unmuted yourself, is the Bitcoin case comparable to the GameStop case?
Listen, I think there's a few common elements, but also like big differences. I think the first one is obviously not all cryptocurrency, but the whole idea of cryptocurrencies, decentralized finance is a new paradigm, right? That people expect to potentially challenge existing finance, right, and existing currencies. And so I think it's like there's, first of all, it starts with a really interesting technological innovation that might build some real economic value, right? So I think that's a little bit different to the GameStop hypothesis that, you know, I don't think anybody can see right now the economic value around the corner that's going to get built up. Potentially it might happen, but that's probably not what has driven the price action as of late. So I think there's some real opportunity around cryptocurrencies and decentralized finance being incredibly economic platforms down the road. But I think what is the same thing or kind of similar things that are happening is obviously the frictionless nature of engaging in cryptocurrencies and buying them on a fingertip in very small amounts that we never had, and that's a little bit similar to what happened with GameStop and Robinhood. Obviously, cryptocurrency is even more less friction, more global, a much bigger market than a GameStop. And secondly, what is happening is obviously that social media and communities play a really big role. And I think especially when you look at cryptocurrencies, the early supporters of cryptocurrencies, and you saw that especially with Bitcoin, but you see it increasingly in Ethereum, it's just almost like a cult-like following of these cryptocurrency platforms, and people really believing in the mission and the long-term outlook of these platforms, and certainly promoting that in that way and communicating that way. So overall, I would say it's a different economic case. I'm a big believer that there's a tremendous upside in the economic case, but some of the underlying factors why it has gotten so much traction so quickly and why there's so much price action is certainly similar to what happened to GameStop and what we've seen there.
And if I may jump in there, I mean, this question has been pondering in the back of my mind for ever since this GameStop phenomenon happened. And to your point, Professor Rudolph, about this, the efficient markets, when, you know, for example, in the movie Wall Street with Michael Douglas back in the day, and when he's calling in the pump and dump scheme, this in the American stock market, this is illegal. And if you get caught doing this, which is, you know, telling people that this company is highly undervalued when it's not, so therefore manipulating this efficient market communication, this is illegal, and you can go to jail for that. But with GameStop, they intentionally manipulated this communication, of efficient markets. They manipulated the efficient market. It is not worth it. GameStop stock was definitely not ever worth anywhere close to $500 per share. But because they didn't say on Wall Street Bets that it's undervalued, that's why you should invest. Instead, they said, no, we just want to screw with the establishment and give the middle finger to the hedge fund managers. So please buy GameStop. Because they said it in that way, it wasn't illegal. And therefore, there's this new, going forward, will there need to be legal intervention into these sorts of things to make sure that we don't have what happened to GameStop, which is not valid. I mean, on any point, the company was a failing company. I shopped at GameStop many times as a teenager, but these days everything's digital, like Professor Rudolph said. So I wonder what you guys' opinions on is the moving forward on would there be any legal action for these kind of legal pump and dump schemes to prevent this in the future?
Well, maybe. I mean, if I basically can second here, I mean, what is regulatorily legal and what is regulatorily not legal might also be distinguished between the old view and the new view. I mean, we're talking about here old finance and new finance, and now since information, also wrong information, if I understand your point correctly, can so easily be distributed, much easier than in the past. Maybe this is a very relevant thing for regulators also. Simon?
Yeah, I think that's going to be really hard because in the end, it is also the reason why we have no efficient tool against fake news, because it's very hard to determine if something is true or not. And to be judge of that, it's almost impossible, I don't think you will create an efficient regulation to that. And especially since the GameStop guys were not saying necessarily, they were making reasonings. They were writing the small pages of this is my analysis, this is my reasoning. And, it is not illegal, to say something that you think is right, but it's obviously not true. And nobody can prove that you knew it wasn't true. So I don't think that there's no way to do that.
Interesting.
If I may say something to this, I mean, you also saw before the GameStop share companies even listed in the German biggest index that were apparently valued in a wrong way for a couple of years until some truth finally came out. And, I think it's a question of speed because fake information and information can be distributed much faster nowadays. I'm not sure if it's the fair value of the asset, the price hits the fair value of the asset faster. I think it's still volatile around it and eventually it hits it. But I think people may still be wrong there because they just get the wrong information at the wrong point of time. So I think it's pretty tough because this is what you're saying, right? Because information is distributed faster. So actually share prices should have a lower volatility because there is no classical information gap, which you have in the non-trading times on stock markets and so on and so forth. So that may, I don't know. I don't see this yet.
If I may, or Matthew, did you want to add something to that?
Yeah, sorry. I was just going to say quickly. I mean, I think the whole GameStop phenomenon is incredibly fascinating, and I wouldn't be surprised if there's a book written about it or a movie because there's a lot more than I think most people know. It wasn't just retail investors. There were also some very sophisticated operators who got in on this and made huge amounts of money. And the initial thesis that was going around the Wall Street Reddit forums was actually quite sound. I think I remember at the end of last year that apparently over 100% of the free float was shorted, which is, and I haven't verified that, but if that is actually true, is pretty incredible that you would have such a large amount of the free float of a company shorted. So obviously that puts the shorts in a very, very vulnerable position to experience exactly what we saw with GameStop. So I think what started out as actually a genuine, interesting, and valid investment thesis, or certainly a trading thesis, turned into something completely different. It's probably a topic for another perspectives panel, but I think very quickly what happened with GameStop, and I think what's happening in the crypto space is a manifestation of underlying themes and trends in the market, and that is, I guess in a nutshell, it's kind of a disassociation by the younger generation to the financial systems, a feeling of incredible wealth disparity, and that the younger generation are missing out. They think the system is rigged, and this was a chance to give the system a black eye. So incredibly fascinating what's happened there, and it's still happening, in fact, now with crypto.
Yeah, I absolutely agree. It is very fascinating, and also because at least I have to admit for myself that not everything has been understood yet, at least not by me, but I guess there are other people, because the things are really following new rules. Maybe Simon, if I may ask you, I mean, we were talking about Bitcoin as an example for a cryptocurrency, but we have other cryptocurrencies, Ethereum, which I think is very much more sophisticated, but also Dogecoin, which I didn't think is very sophisticated. Could you explain us a little bit the differences between the hypes that we have seen with Bitcoin, Dogecoin, Ether?
Yeah, absolutely. I would love to. So Bitcoin, of course, is one of the oldest one. Came directly out of the financial crisis. I would call it an MVP. After all, it's a minimal viable product. It shows the basic logic of what we can do, why we can build a financial system that has no central authority that controls it, but that is self-controlling. And Ethereum is kind of the big deal, so to say. So Ethereum brings a lot of more innovation into it. There's not only, okay, we can not only trade, but we can program this money. We can create smart contracts, which is basically you can command money that it does something. But now this is very interesting because the money does something without oversight. And of course, you can for example, salary payments can be a smart contract. And this, of course, creates a lot more security in so many aspects, to have contracts that cannot be broken and that act on defined triggers. Okay, the package, the supply has crossed my factory gate and the payment is triggered. I mean, I don't need to explain depending why this brings a lot of efficiency into the market, right? Like there's so many things, so many middlemen that we can cut out. There's so much efficiency that we can increase. But now Dogecoin kind of brings a big value question, because what is Dogecoin? Dogecoin is kind of a copy-paste version of Bitcoin. The few things are different. For example, while Bitcoin it has a built-in deflation, so we have fewer and fewer Bitcoin coming into the system. There's a built-in inflation in Dogecoin. So, like right now, I wouldn't buy Dogecoin. I would mine Dogecoin, because mining Dogecoin is super easy, and you can directly exchange it for US dollars. So, just as a small hint for one or the other nerd that's listening. And so we have these three categories for now. And the one question, and I had this wonderful conversation with Matthew the other day, is, has Bitcoin value, right? Like, is it 50,000 US dollars worth? It doesn't pay any interest. It doesn't give you a ride. Does it really have this value? And my personal opinion is yes, at least for now. And the main reason is it's really, Bitcoin is not an innovation for us so much that we live in the first world. It is really for there's 1 billion people right now who live in who engage with remittances, either by sending or depending on them. And well, remittances are mostly sent in countries with rather dysfunctional institutions, with unstable governments. And you have seen that Nigeria, for example, has blocked Bitcoin recently, or cryptocurrency, and so has Turkey. And why have they done that? Because the local population is acknowledging that these currencies are more effective, are more reasonable tools and means of exchange than the local currencies. And that is a big statement. And I think this is something we often forget when we talk about the price of Bitcoin. That is literally, there's I don't know, I think Paxful was the name of the exchange. It's one of the few exchanges that allows Nigerians to trade. They had this year alone 1.5 billion transaction volume, and much of that was remittances. And this is also the reason why these governments are trying to stop this outflow, because it has become such a valid alternative to the traditional financial system, and especially because it's without government.
You know,
and, yeah.
on that point, Simon, we have a question from one of our audience members from YouTube. Raphael asks, you know, what role does the entry of these institutions into the crypto market result in? So how will these institutions? I know the EC, the European Central Bank, came out very against it, but we have you know, on the other side, we have funds in Germany that are accepting Ethereum. We have major institutions coming back and giving legitimacy to cryptocurrency. So yeah, how will this affect regulation and ultimately the individual investor? And jump in, anyone that for an answer to this one. Mm-hmm.
Maybe Matthew, because you have been addressed already, and maybe we can also link that to another question that I'm interested in, namely, if cryptocurrencies have value, or if cryptocurrencies don't have value, how could you then explain that there is such a big market for Meebits, CryptoPunks, and these things? So maybe, I don't know, it's a complex question, but maybe you can connect those two things: institutional relevance and value of cryptocurrencies.
Yeah, I think those are two separate questions. What does the role of institutions in the crypto market? Well, I think what that means is that the potential audience and if you want to call it investor, or I would actually call it participant base, will get bigger, because if Goldman Sachs or Morgan Stanley have a crypto desk and they allow their clients to trade through them, that will open up that market to a broader number of institutional and investors. That has nothing to do with what the value of those crypto assets might be. And I was speaking with Nicholas the other day about this, and you know, I'm currently going through a transition from, you know, leaving behind, I guess, the old finance, and I'm moving headfirst into the kind of new finance, and I've kind of stood back for years and just watched kind of amusedly how, you know, the rise of Bitcoin and the rise of cryptocurrencies. And I really spent quite a bit of time recently looking into this and trying to understand where is this value coming from. And there's kind of two camps. There's the camp of Warren Buffett, Charlie Munger, Jamie Dimon a few years ago, who said Bitcoin is worth zero, should be zero. And then you've got Mike Novogratz and you know the Winklevoss twins and others who say it should be equivalent with gold, so it should actually be $500,000 a Bitcoin. I put myself, after looking at it, I put myself more in that Bitcoin is worth zero, because it represents nothing. It was created from nothing. It doesn't represent actually anything except a computer program, computer code. But then I was reading a very, very interesting blog by Ben Hunt from the Epsilon Theory. And when I first read it, I thought he was crazy. But the more I thought about it, he was exactly right. And he says that Bitcoin is not worth nothing. Bitcoin is worth actually potentially quite a bit, because Bitcoin is actually art. And there is a lot of value in good art, because good art is a very scarce thing and it never gets used up. And I think this also explains why is Bitcoin $50,000 and Bitcoin Cash $1,300. There was a fork in the code a few years back. They're almost identical. Actually, you could argue from a utility standpoint, Bitcoin Cash should be worth more, because you can do things with Bitcoin Cash that you can't do with Bitcoin. It settles faster. You can trade more. You can do more transactions with it. But there will only ever be one Bitcoin, just like there will only ever be one GameStop. And what I think is happening is this has created a phenomenon in the market. But I think when people say that Bitcoin should be viewed as a store of value, I think that is ridiculous. I think Bitcoin is a store of volatility. It's not a store of value. But if you look at it from the perspective of art, then a lot of things start to make sense.
Well, that's a very interesting viewpoint.
But how do you explain then how do you compare that to gold? I mean, gold is always the traditional store of value. It's highly volatile as well. you can just say it's digital gold. So I get the notion of art and perhaps like the uniqueness of Bitcoin, but I'm not just. I still think like it's closer to a digital gold that is frictionless, global, better transportable, permissionless. And in that characteristic, that's closer to art.
I think I actually was in that camp for quite a while. That cryptocurrencies, Bitcoin, is kind of a virtual gold. But again, the more I looked at this, the more I realized that argument actually doesn't have much to stand on from my perspective. And that there's a few reasons for that. One is gold has been a store of value for thousands of years. Bitcoin has been around for, I think, 12 years, 13 years.
2008.
So there is a fundamental tenet in finance and the value of anything, and it's trust. People have trust in gold. Also, gold has utility. It's an incredible conductor of electricity. It's used in jewelry. It has industrial applications. It's in everybody's smartphones. And then in the other corner, you have Bitcoin, which, what can you do with Bitcoin? You can exchange it for fiat money if you own some, but Bitcoin itself it has no utility. You can't do anything with it. So I think it is tempting to make that argument, but I don't believe that really holds much value.
Nicholas, I really think we need to get to an end because things are running very quickly. Is that right, Nicholas? I mean, so we should enter into the discussion meanwhile, right?
Yeah, I mean, this is where we're at. What is the value? I mean, I think this is what our viewers are really interested in is what is the value of crypto? Why does Bitcoin trade for 50 grand? Why is Dogecoin now 50 cents when it was, less than a 0.001 a year ago? The main point, I think Mr. P. Huza has said this correctly, is I think this is what is on our listeners' minds. What do you think will be the future use of crypto, and will it replace fiat money? Will we come to a world that ever happens? And I wonder, with the discussion going on, Matthews, your point where Bitcoin is to be valued as potentially like a Picasso in a house, where this has artistic value but can be replicated. The blockchain technology is not unique in its own, but the fact that it is a Bitcoin and it was the first blockchain technology, that has value to it. Or Dogecoin, the fact that it's a meme, the fact that it's the masses pointing the middle finger to the establishment, that has value in the fact that it's Dogecoin. But the technology behind it is not what is valuable. Whereas on the other side, we have Boris and Jürgen and Simon, who have this other idea of what is the value of crypto, and will it replace fiat money? And this idea that crypto, the reason it was invented was to detach the dependency of finance from governments. And what happened with the quantitative easing after the 2008 financial crisis, where the U.S. essentially printed money, the blockchain no longer allows this to happen, and that is, in other words, also valuable. So I wonder what you guys think about this question.
So perhaps let me just one I think fundamental point that is super important and important to me to make. The public and this discussion is way too focused on Bitcoin as a store of value and replacing fiat. I think Bitcoin was just the first application of blockchain and cryptocurrencies. And sometimes it also looks like the most ridiculous application, like who would ever replace the US dollar, right? We'll see how it's going to play out and if it's digital gold or a piece of art. I think what is much more important is crypto-driven networks provide for the first time a incentive mechanism to organize information markets at scale driven by computer programs, right? And so every single information market in this world will at some stage move to a crypto-driven platform where the participants, the users, the suppliers will build their own economy of trading information services over that platform. And that, I think, is like much more important than the question is if Bitcoin is worth $50,000 or $200,000. It's the remaking of information markets on a global scale, driven by computer programs and in kind of driven by incentives for all of the participants. And you see that already playing out right now on the Ethereum platform with decentralized finance, where you have an exchange like Uniswap that is basically a peer-to-peer exchange for tokens and currencies where there's no middleman. And actually the people that are participating in it, the liquidity providers, the market makers, they're getting fees for providing that service. It's not a single central instance that does anything like that. The community owns the protocol. They do the governance. They vote on governance proposals. And that, I think, is the super exciting vision for cryptocurrencies or kind of tokens in general. I'm less focused on Bitcoin and how much it's worth. I think that's the real innovation that we're going to see.
Yeah.
And
yeah, I would agree with Boris completely on that point. I think in a few years, 5 years, we're going to look back and we're going to see Bitcoin and cryptocurrencies as we see them today we're just the opening act. It's not about, the big story is not about cryptocurrencies or Bitcoin. The big story here is about blockchain and the value that blockchain can release in many different asset classes. It will create a completely different investment paradigm. And I firmly believe I don't know how long it will take, but in 5 years, 10 years, Bitcoin will go where Bitcoin will go and Dogecoin will go back to near zero. But no one will be talking about then because it will all be about blockchain and tokenized assets and everything that can be done with that. And it's an incredibly exciting technology that's going to transform finance as we know it.
And that might also give a part of the answer to the question which was just raised, namely whether digital currencies are going to replace fiat money currencies. So maybe it is so that the existing cryptocurrencies that we currently have are probably not going to replace the fiat currencies that we have, but that a classical monetary system like the dollar or the euro will be digitalized on the blockchain. I think this is more or less for sure. Could you say it like this, or is that right? I mean, Boris, you said any piece of information one day will be on a blockchain. So, and that's the conclusion. But Jürgen, I think you want to say something.
Yeah, I think I think that the discussion is driven by greed, which is a very strong human motive. That's why everybody's talking about the Bitcoin price. I was personally surprised why this pickup of Ethereum just happened so lately, because I think the network really has the thing that I was seeing in it when we started mining on it. But it took quite a while to catch this up because there was so much around the Bitcoin thing that shifts now a little bit. I really believe in that the Ethereum technology and the smart contracts, which is like the easiest thing to see that you could cut out a middleman there, like on the option market, issuing bonds and so on and so forth. But even that is, I think, hard to evaluate how much then one Ethereum would be worth. I think it's a very difficult question. If I would get a guess, I see Ethereum more on the rise, the Dogecoin thing. I mean, I don't know. I don't understand. I mean, I have to admit this. And the Bitcoin, I mean, let's see. I mean, the time that they're still going to issue coins is going down. It's really short now. So let's see what happens to this network once, nobody can make kind of ownerless money through mining. And then we see what will happen to this network. And I think it's extremely tough. I mean, at the moment, everybody that is invested somewhere is like super happy about it. I guess that's also the reason why we have this talk right now. We wouldn't necessarily had this a year ago. I mean, I'm happy to have the same panel again in half a year and see where we stand. And then let's see what the noise is then going to be and where GameStop is going to be. And I think then Markus is going to say, Pharma was right. It was just some behavioral humans acting that, shifted in the wrong direction.
speaking about behavior, we do have a comment from one of our guests that asks about the connection to Robert Shiller's narrative economics to explain this phenomenon. And I guess this is also kind of talking about the GameStop idea as well.
Well, that's a very good question. And I mean, when this discussion is coming to an end, I would like to make something like a closing the loop. But I think the closing the loop between old finance and new finance is by behavioral aspects of finance. So I think really this is the connection point, because I mean I'm the moderator. I'm not asked really, but that's at least something that I want to imply. Does anyone feel entitled or competent to answer that question? Behavioral aspects of cryptocurrency values? No. I mean, one thing, and Linus, I would like to get back to that as soon as we close the loop. And I don't know how disciplined we have to team with the time schedule, but it's typically good advice to basically use not very much more than the scheduled time. But one thing that I really would like to understand before we close in that context of cryptocurrencies and blockchains is this market for art or Meebits, CryptoPunks, all of those things which are tokenized by non-fungible tokens. I mean, you mentioned that, Nicholas, in the very beginning, namely that there was one piece of art sold by Christie's, I think it was called People Every Day or something like that, for real money, not crypto money. Is anyone here, so as the very last aspect of the whole thing, who feels competent enough to explain that to me or to the audience? Why are people paying $60 million for a JPEG file?
I would love to go on this one, actually, if I might. Sure. And it actually plays into something, and I want to pick up again, actually, something that Boris and Jürgen both said, and also Matthew, is the incredible power of the Ethereum network. And a lot of people ask me, okay, what is the use case? What is the use case of Ethereum? And I really want to bring this message across to all the WHU students who are listening right now and are still studying. Ethereum is more like the internet than it is a currency. It is the internet of value. And that means you ask me for a use case, every single application that you're using in the internet right now, we need to, or most of them, or many of them, will rebuild them on Ethereum. Social media, we'll rebuild them. And why do we rebuild them? Because the first time the internet was this copy paste for free for all, and this will end now. We will go to an internet of value where we have an exchange. So I produce content, I get value back, and I consume content and I give value back so quickly. And NFTs are one of these use cases. So an NFT is simply a token that is limited in its in the amount of tokens that exist. So I can not only, like if I have a pixel of a Picasso, I not only know I have one pixel, I know exactly which pixel I have. And that makes it so interesting for art now. For one, I know exactly which piece of because like before that, right, like we had only copies. We have the very first time in the digital world with originals. And this is now what we sell as an NFT. We have we are not copying. It's also technically interesting. So we're not copying the original data that has been secured on a server and display it, but we stream it. And I know some techies will now probably disagree with me, but as I understand it, it's about that. And so we have now in digital original, and I just want to say, if NFTs have these value, I was talking with a few people about it, and they were saying a little bit like they said it's pretty difficult right now because some of these NFTs simply give you a private license, so you buy it for 60 million or whatnot, and you're only allowed to, I mean, you're not even allowed to display it somewhere, which is just crazy. So but the use case, right? I mean, NFTs, you can not only use them for art, but you could use them for certificates, for digital. Microsoft license could be NFTs, right? And this is, again, I would say, as Bitcoin is just the primer for blockchain, so is these NFT sales. Just there's a new technology on the horizon, and it's going to change a lot. It's going to change finance and many other industries. And I would really encourage all the WHU students to look into that.
All right. Thank you very much. And thank you very much to everybody who was here. Let me now try to really close the loop and come to an end. what we have seen, I mean, we were starting with the question of whether information is still appropriately processed by the markets, and we were discussing a couple of counter examples, or at least examples which seem to be counter examples against the efficient processing of market information. And I think that is a very good format to address those questions. And I'm also very grateful to Nicholas and to Mattia, who have organized this session, because that gave us the opportunity to talk about those things. And if I'm coming back, my impression is the following. I mean, even in the old days, we always had situations where markets have not yet been understood by the people. So one of the most often cited papers in the world is Rolf Bann's small firm effect paper, where small capitalized companies basically traded at prices which were considered to be crazy at that period of time. And what I think personally is that the markets are acting based on behavioral attitudes. So the markets have a certain behavior, but they have not yet perfectly understood the information which is there. So what is wrong, according to what I think about the efficient market hypothesis, is the assumption that information is understood immediately. If you modify the efficient market hypothesis and say it takes a while until the participants at the market, even though those are really many thousands and hundreds of thousands of people, but still it takes a while until the market is becoming efficient again, then I think the whole thing begins to make sense again. So we are not perfectly understanding, I guess, what the value of NFTs, of Bitcoin, of Dogecoin, of Ethereum is. There is a value. It seems to be a value, at least that this is what the behavior of the people shows us. Hey, I mean, they assign a value to it. It has not yet been understood. So therefore, my conclusion, also based on that discussion, which was very enlightening, is markets are probably still efficient. I mean, somebody cited also Warren Buffett, who said that markets are voting in the short term, and in the longer term, you get to a stage which is rather a stage which could be characterized by efficiency. So I'm glad to say, as a professor of finance, that not everything is useless what we learn in the classroom. However, it has always to be adopted, and it's a very exciting discussion. And of course, everybody needs to basically be on the pulse of the time, because they're always coming up phenomena which are new, which are not understood, which people don't understand. And that's also what is so extremely exciting about financial markets. That's at least what I think. And therefore, thank you very much, Nicholas and Mattia, and thank you very much, Matthew and Boris and Simon and Jürgen, for joining. And thank you very much to everybody who is out there, whom I cannot see, but I guess you see us. It was a great pleasure for us, for me, for everybody. And I hope that you keep connected to the financial markets, and more importantly, to WHU or to Weizmann School of Management.
Thank you so much, Professor Rudolph, for that generous outro. And I would also just like to add onto the list of people to thank for tonight's event, the WHU Video Department, WHU Marketing Department, and of course, Felicia Hummel and Alexander Denica from Impraxi. We appreciate all your help in making this event possible. And of course, one last thank you to our wonderful panel guests. We hope to see you all back here at one point on WHU Inside Business. This is our new live series that we're calling Perspectives, with the inaugural episode as of now completed. So good luck to all of you in the meantime, and we hope to have you back soon.